Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for August 31, 2020. Please see our disclaimer for important information. So in our Market Minutes this week, we'll talk at some length about what happened at Jackson Hole last week with the Federal Reserve. It's the annual symposium hosted by the Kansas City Fed, and it really served as kind of a bit of a tectonic shift in Fed thinking from what we've seen over a period of time. And we'll kind of talk about the implications for the equity market, the investment markets in general, and really kind of what it means for us here and now as we kind of head into the last few months of the year. But let's get caught up on the market from last week. So last week the Dow was up 2.6%, the S&P 500 was up 3.3%, NASDAQ was up 3.4% for the week, and the Russell 2000 was up 1.7% for the week. And the S&P 500 and NASDAQ reached all-time highs, and the Dow itself, having clawed back into positive territory for the year, is only about 3 percentage points below its all-time high, if you can believe that. So, you know, if you look at it month to date, all the major indices did fairly well. Volatility was down. We've got a slide on that in our charts of the week, which I found particularly interesting amidst all the volatility that we had earlier this year. But for the month, you know, the S&P's up 7.2, the Dow's up 8.4. NASDAQ is up 8.8, and the Russell 2 is 6.6 percentage points higher. And for the year, of course, NASDAQ is leading the way, 30.3%. But you know, the Dow, as I just mentioned, just eked out a positive year-to-date performance, just above the flat line. And the S&P now, with this tremendous rise, is up 8.5% for the year. Small caps are down. I think some of the implications from the Federal Reserve meeting last week are not particularly as beneficial to small caps as should say, but needless to say, just kind of roaming around the different markets, Barclays aggregate was down a little bit. You know, we had a little bit more inflation. Inflation pressure, I should say, or at least expectations are perhaps beginning to build based on what the Fed told us. And even though the Barclays aggregate bond index is up about 6.6% for the year, it was down for the week. And then oil, based on the hurricanes, the twin hurricanes, was up slightly, about $43 a barrel. Month to date, crude is up about 6.7%. Natural gas is up almost 50%, and even gold was a little bit flat this week. We've seen a little bit of chop in gold after it reached kind of an interim high, but gold is still up 29% for the year. U.S. dollar lost a little bit of additional ground last week based on what the Fed did in their meeting and the anticipation for lower real yields or negative real yields, and we'll talk about that too. Year to date, the dollar is down about 4.2%. So, you know, we saw the spreads on high yield bonds narrow a little bit. You know, we've seen, you know, the 10-year Treasury yield pop up a little bit. It's been hanging in kind of a, you know, basically the 60-65 basis points level, and it's kind of perked up to about 72 basis points, or 72 100ths of a percent. And the 10-year Treasury is still down 120 basis points, or 1.2 percentage points for the year. But, you know, equities rose. The S&P 500 rose for the 5th straight week, and as I mentioned, close to an all-time high. The new inflation policy framework by the Fed is kind of basically almost set up a perfect scenario in which, you know, basically a perfect scenario for stocks in which monetary policy is likely to stay firmly accommodative, you know, despite improvements in the economy. And the dollar weakened to the lowest level since 2018. So what that does is it helps stocks that have a larger percentage of foreign revenue because of the dollar weakening. because it basically translates higher overseas earnings, and so that disproportionately disadvantages small caps, which tend to have less overseas revenue. But needless to say, tech firms continue to lead. Healthcare, both of those areas tend to outperform. 10-year Treasury moving over to bonds was at a 10-week high, as I mentioned, to 72 basis points, and credit markets are getting a lift from this new risk-on move that has been driving equities as well. But we talked about commodities a little bit. The economic backdrop from last week, the housing market continues to outperform and continues to perform extremely well. We have some data and some charts on that in our charts of the week as well. But housing price growth and new home sales are all beating expectations right now, despite the fact that consumer confidence has fallen to basically a crisis low of around 85, and again, we have a chart on this as well, but the younger cohort has had a larger drop in confidence that we've seen in the older cohorts. But essentially, and we'll talk about this, but the backdrop on the Fed is that they have said that they still want to target inflation that averages about 2% over time, but they can absolutely tolerate inflation running higher than that, so that over a longer period of time it will average 2, and that's not been the case. So the big tectonic shift here is, instead of saying we want to target 2, and we know inflation has not been near 2 by the yardsticks in which the Fed measures inflation, so what they're basically saying is we're going to keep rates low, we're going to let inflation overheat, so that over a period of time maybe that does average 2%. So there's clearly some implications there, but it does give the Fed latitude to keep rates low even as inflation rises or the labor market tightens. But as you sit here right now, the S&P 500 PE ratio is about 25.3. It's the highest since 2002, and the forward PE ratio is about 26, which is the highest level since September 2000. And basically, the price to earnings ratio for the median stock has never really been higher, and we're at a relatively high level on not only the cyclically adjusted PE, but also stock valuations are high relative to the economy or GDP. But basically, we've got a lot of things to talk about this week. That some cross currents. Obviously, equities are continuing to be very strong, and basically, stocks could outperform bonds over the next 12 months, in our opinion, even though stocks come under some pressure if interest rates rise. And there's not a whole lot of impetus on inflation, but there's expectations building that with this new shift in the Fed policy, that you could get expectations rising, which would drive longer-term interest rates higher. And if that happens, basically, the multiple expansion that stocks have benefited from this year has largely been driven by basically multiple expansion, but a bond market sell-off and corresponding rise in interest rates could certainly negatively impact stocks, which are, I think by most yardsticks, fully valued right now. But just looking at the debt markets, obviously we're still concerned with rising debt levels and deficits. We're going to have to pay the piper at some point. There's no doubt that the high budget deficits and debt to GDP ratios are probably unsustainable over the long term. But we've had this kind of situation brewing for quite some time, and revenue levels and debt service capabilities for that debt have been manageable to date, but that obviously could change at some point. And as we see amongst advanced economies, debt in July rose to 128% of GDP, and this is kind of an average over advanced economies. And and it was basically about the same level right after World War II, and during the ensuing decade and decades, high growth and low interest rates were able to help reduce that ratio. But right now we have low productivity and we don't have any inflation to speak of. And we have some cross currents in our economy. So we've got weekly jobless claims are about roughly 1 million, and that's I think they're down a little bit, but they're still a little bit higher. They're obviously 5 times higher than they were prior to the pandemic. But good news is continuing claims are decreasing at a fairly slow rate, but we are going to see some dislocation because the airlines, we've heard from American, they're getting rid of 19,000 workers. We know that United have said, over 35,000 workers are at potential risk of layoff. And, with travel being 70% lower than a year ago, that we know that there's a lot of risk in the transport sector for employment. And so, even though we're seeing better data, we know that there's some risk factors on the horizon there. But let's see, looking elsewhere, obviously we've got a lot of cross currents. We know the pandemic is on top of us. We know that we're kind of in the midst of extricating ourselves from the sharp recession. We've had a fair amount of civil unrest lately, and then we've got elections coming up. And I think by most measures, the election seems to be tightening up between Biden and Trump. And, I think it's just going to, if we continue to see stronger data, I would expect that number to tighten up further and create more uncertainty out there. But the other thing, too, on the political scene is that the prospects for future additional fiscal stimulus are really looking a bit uncertain at this point. We know that there was deadlines that have been missed and targets which have been missed by legislators on both sides in trying to build a framework for a deal. There's a new deadline of September 30th. And the government has to do this. They have to pass a continuing resolution to be able to continue to fund the government anyway. So we figure that there's probably going to be some stimulus built into that continuing resolution. But I think there's a large faction out there that says, well, the economy is doing better. We know unemployment's going down. So why should we be motivated to promote more stimulus? And I think that's a bit disingenuous, particularly to the small business sector, where there are jobs being lost every single day in small business. So I'm not sitting here as an advocate for a particular level of stimulus, but just recognizing the fact that there's still a lot of small businesses that are not getting the publicity that are hurting quite a bit right now. But I still think that inflation being low, with this new shift in Fed policy, it could accelerate. So we have to be on the watch for that, because as I mentioned before, that could be have negative implications for stocks. We don't necessarily see an imminent rise in that, but I think this Federal Reserve is smart enough to massage their words and to be very careful in how they proceed with interest rate manipulation, to not throw off the market, which is clearly feeding off of this liquidity. It's clearly feeding off of this speculation that the Fed is going to keep money loose for a while, which has always benefited stocks, and obviously it's priced into the market now. So I think the Fed's going to remain ultra accommodative for the foreseeable future, and obviously the Fed, their support has been a huge catalyst for gold as well as equity prices. But the one thing that we're going to have to watch out for is the risk of something reversing, in the way of a bubble. Now we saw this in late 1999. We certainly saw it in 2000, really 6 and 7, heading into 08. So the bubble was being created in different areas in each of those times. But the Fed policy is clearly creating asset inflation, if not consumer price inflation right now. But I think all in all, gross domestic product coming in for the third quarter might be even a little bit better than expected based on some of this data. I mean, we could see a number, anywhere between like 20-25% up year over year on an annualized basis. I'm not sure what to think about earnings for the S&P 500 just yet because forward multiples, as I mentioned, are extremely high. So I think we just have to be real cautious about equities, even though there seems to be a lot of fuel behind this move right now. A couple of other things that the government has done. The SEC has expanded its definition of accredited investors. So basically, for the longest time, it's been basically a net worth of $1 million or annual income of $200,000. And it's according to Sandy Leeds, basically in 1983, there were about 1.3 million accredited investors, and now there are like 16 million. And so the SEC is going to be expanding that to people that have perhaps a stockbroker's license or have advanced degrees and things like that, advanced education. Basically the implication is that these are people that are going to know and understand the risks, which I think is pretty interesting. And what that, basically this is coming out of the Wall Street Journal article, but the supposition there is that you have more accredited investors, you're going to have more investment in the private markets, and the SEC's estimate is that $2.7 trillion was raised in private markets last year versus only $1.2 trillion in the public market. So, as you begin to think about the emerging from this recession and this longer term recovery, that there's the opportunity for much more money to flow into private investments versus the public markets. So I thought that was fairly interesting. A couple other things related to money flowing into markets. The article in Barron's this weekend that we should continue to see a lot of initial public offerings coming. There is this term called SPAC, or Special Purpose Acquisition Companies, which are basically shell companies that are publicly traded that acquire companies into them so that they can have an easier path to go public. And we've seen a lot of these companies emerge. This is not a new phenomenon, but we've just seen a lot more of them lately. And there's a lot of high value companies out there. And in fact, some of the biggest private companies, and there's just a whole slew of these that are waiting to come public by these types of vehicles, like Virgin Galactic. DraftKings was another one of these that came via the Special Purpose Acquisition Company, or SPAC. But there's more IPOs coming, so beware of that. Then another thing that has been on my mind for quite some time is the fact that that we've got struggling municipalities and states to a large degree. States are facing a budget shortfall of over $550 billion for the 3 years through June 2022, and then basically for municipalities it's $360 billion. So I mean, that's approaching $1 trillion of shortfall for basically a lot of entities and states in particular that cannot by law go into bankruptcy. So I think we're going to run the risk of some dislocation in the municipal bond market, even though we've seen a lot of issuance in muni bonds this year as people are trying to rush to market while rates are low. General obligation bonds are 26% of the municipal bond market, and so if you have a rash of ratings downgrades, you could have a fairly strong dislocation and price shift in an adverse way for muni bonds. So General obligation bonds are 26% of the market. City and state governments account for approaching 20% of gross domestic product. So we know that, with cities and, transit authorities in particular that are seeing ridership drop through the floor, we've seen a lot of problems in those areas, and they haven't really translated into price changes in the muni market. But I just want to be careful and caution people that that is clearly a risk. And the muni bond market is not insignificant. It's almost $4 trillion, and yields are at their lowest level since the 1950s. And we have a whole lot of new issuance right now that's flooding the market. And I guess my passing caution as we transition the conversation here is that we could see a continued, or not a continued, but we could see ratings downgrades as some of these municipalities fall into kind of financial disrepair, if you will. So anyway, something to keep our eye on. And I might just close with just a couple comments on the Fed. Again, kind of putting a bow on this Jackson Hole summit over the last week. Basically rates, the implications for what they did are basically that rates are going to be lower for longer. And if they're going to be lower for longer as we wait for inflation, the big question is inflation going to come? We've been waiting for inflation with quantitative easing for years and years and years, and we just haven't seen it. We've had higher productivity. There's basically more, levers to kind of keep inflation flow. But if the rates are lower for longer, and will it lead to inflation, and will it lead to expanded bubbles, beyond what we have right now? And these are huge risks that, we just don't know the answers to these questions right now. We know that the potential longer term growth rate of the economy is down from where it was. The general level of interest rates is down both in the U.S. and around the world, which has kind of basically created a drop in the neutral rate. But we have this long expansion that led to the best labor market that we've seen in a generation, and gains in the labor market were pretty widespread for the most part. But we know that that things could change over time. And essentially, we're not going to see a large interest rate increase until perhaps late 2024. And and the Fed basically is no longer going to tighten rates just because the jobless rate falls below what it considers to be full employment. And I think as long as we have forces that are keeping inflation at bay, like slow labor force growth, the fact that high cost labor is being replaced with cheaper workers outside the U.S. to the extent that we don't become more protectionist here in the coming years. But technology obviously is helping that trend, and job growth has been concentrated in lower wage retail and hospitality in some of those areas. But the real beneficiaries of keeping rates low are going to be both borrowers and clearly going to be the financial markets. And so I think this whole new emerging thinking, what called modern monetary theory, or MMT, is going to predicate our markets for the next several years. And I think we're going to have the risk of these bubbles. We're going to have perhaps longer, prolonged periods of stock and asset price inflation that are disrupted when we hit these bubbles bursting. And I think that's probably one moral hazard out there, that people feel like the Fed's always going to be backstopping the economy with more and more liquidity, that basically under modern monetary theory, that the Fed can, or we as a country can, borrow without limit in our own currency while we don't have inflation. So anyway, I just had some of these passing thoughts from readings over the last weekend and coming out of that Fed meeting in Jackson Hole. I think there's still clearly impetus for stocks because of this. Stocks are highly priced. They could correct. I just want to guard against that. So we've added some protection in our accounts for downside with that. I think we've added some inflation protection because I think there is the possibility of inflation seeping into the market a little bit. And I think we want to caution against that. And obviously keeping quality relatively high, especially now that that there's been such a strong move in high yield on the fixed income side, and lower quality has really improved. But I think focusing on multinational exposure, because I think the dollar is going to continue to remain low. Focusing on adding some inflation protection, but also emphasizing quality and staying relatively short on maturities until we get a better read over inflation is going to be paramount. So anyway, we'll continue to monitor the fallout from the Fed's change. We'll continue to monitor the news flow as we get closer to the end of this third calendar quarter. And we're going to continue to maintain an optimistic tone, but I will just call it guardedly optimistic. We hope that you have enjoyed Market Minutes for this week, and hope to see you again next week. Please feel free to reach out at the information provided, and hope you have a wonderful week and stay safe.